Good evening. Ira Epstein, and here we are with your metal market wrap-up. And this wrap-up is for the evening, as we're now on Thursday, September 5th, 2024, 5:50 p.m. Central Time. Before I go anywhere, I want to remind you that our sale is coming to an end. Today's the 5th. It ends on the 8th. 3 months. If you're a futures trader, 3 months of my complete futures, twice daily written updates during the day. I write in a bullet type form for you and lead you right into the things that I think are important. Then I back that up with a morning video at 6 a.m. Central Time. I record a video and then I send it right on out to you, the link so you can get right into it. Trade recommendations, stops, objectives, using daily charts, weekly charts, some chart patterns. I talk the talk and walk the walk with you. Instead of $60 a month for $180, you get all 3 months, $99. If you want just the morning video package along with spider ETFs, yeah, because I cover those in a big way. Instead of $84, $49 total for the 3 months. 3 month special on the futures only video. Instead of $45, $29 for the 3 months. $48 for the spider only video? No, $32. There's a cursor up at the top here. Move yourself there. You'll see it off your PC. If you have to call in, do it at that number. The link for this is not on the website. It's a special page you either get to by the email through here, or my brokers can handle this for you. Okay? Now, let's talk about the elephant in the room, because it's going to show itself tomorrow in these markets, and let's go right to it. The elephant in the room is this. You're going to get the August non-farm payrolls data at 7:30. They're looking for 160,000 new jobs compared to the prior month's 114, so a bump. We know what the number is. Anything above that, well, the Fed's going to say, why am I going 50 basis points on a cut? Anything approaching 114 and not getting the expected 160 opens the door for, instead of a 25 basis point cut mid-September, a 50 as I see it. The jobless rate is expected to decline back to 4.2%, and the average hourly earnings, well, they're expected to have gone up 0.3% month over month. You have the numbers. Come in at 100,000, for example. I think you just locked up a 50 basis point cut where the Fed makes its move, goes in a grander way. Come in at 150,000, for example. I think that you're probably still a 25 basis point number. Okay, the Fed will be its usual conservative place, and over 160, I think that's how it works too. So that's how I'm assessing what the market could or could not do. I like gold under all those scenarios. Inflation hasn't really gone away. Wage inflation is not dropping. It's just not climbing very much. There's a huge difference between the two. The dollar down today, minor league. Currency's waffling. Everything's waffling, if you will now, in front of what this report means. Does it mean the U.S. is going in a recession? Well, there's all kinds of signs that that could be happening, because you are looking at the 2-10 yield spread even now. What else? September's a notoriously bad market month for the stock indices. Well, it's living up to that the first 5 days. On the energy market, you did see what I thought would happen. The Saudis came out and they said that the 8 members that are going to refrain from production are still going to do that, and they'll do it through the end of November. All right, so that gave the market a little time. It certainly wasn't a super bullish statement, but it wasn't a bearish statement, and that's important, and bonds and notes are getting a bid. So when we take a look at gold, if everything finished right here, people keep saying, why am I friendly? If you look at a weekly chart of just closes, nothing else but closes, this is an all-time high close. If you were to finish right now and the market ends, how could you not be friendly? The market has stayed over the 18-week average, so the bias of the market is there. I like to use closes on a weekly chart often because it takes away all the drama of the highs and the lows that you get when you go to a daily or a weekly bar chart. Now, as we come here, we can see how the market keeps coming back and fighting its battle right in there. Very interesting battle that is going on. The market had one of these V formations, and then just picked itself back up. The swing line has a higher high, so the peak of this is higher than that. And then this break low certainly took out that break low, so you're not trending. You're just whipping back and forth. What's it doing it against? You've heard me preach to you now for weeks that this rally probably means when you break, you go back to the 18-day average to try to figure out where the market's going to go. Often that's what markets do. It's exactly the number you went to. So if that's the battleground, where's the first resistance on the upside? Most likely the upper Bollinger Band approaching the 2600 level I've been talking at 2578. If the market nosedives, 2490 is likely the biggest support, but you have to get through 2532.90, the 18-day average, to get there. That won't be the easiest thing. Momentum-wise, gold is no longer overbought. So I'm looking for chart setups that just say, get long. I don't care if it comes in the futures or in GLD, the ETF. Often, it's one or the other, and we recently had neat trades in that GLD, took some money out of the market, and it didn't really show up in gold here. That's why I like to use both, and that's why we have a special on that for you. When we look at the gold-silver ratio, the market is over the 18-day average, which means these numbers are climbing. Well, as the numbers climb, what happens, this represents how many ounces of silver you need in a perfect world to put into your shopping cart. You go to your coin shop or whatever, and you say, I'd like an ounce of gold. Well, right now that number is 87.34 ounces. When you're over this number, it means that gold is more dominant than silver at an up price, and that's what's happening. Silver is actually in a sell zone. At the 18-day average, the risk would be getting back over right through here, and the momentum numbers could carry there. To negate the downtrend, you have to take out that high. When you come to the copper market, you went down, made your first test of the Bollinger Band, and as I teach, and you hear me say over and over, the first challenge, if you're not embedded, is often where pros take off all their shorts. That's what I believe, and that's what I think happened here. It's not a change of trend. The trend is still down, and you have two layers of it. From 418.25, let's call it, to 420.35. Right in here, these two numbers, you have to get back over 427 in order to negate the downtrend. What's going to make that happen? I'm not seeing anything positive out of China, so I don't know what will do that. Could it be some support if the dollar gets hit off of the jobs report? Could be, but barring that, I don't see anything that lifts that market. In the platinum market, I see a downtrend that did the same thing. Do you disagree? You went to the Bollinger Band, not embedded, just one of the numbers here under the 20 level. Right there is the day I thought you'd get the short covering of everything, and boom. Now I look for the resistance at 946.90. I think the pros will sell it there with stops over here. So let's assume copper or platinum get over those numbers. They don't start uptrends. They just negate this leg of the downside.